Welcome to a brand new explainer on the Gap Advisors Ind AS Clinic YouTube channel. I am absolutely thrilled to have you here today. If you love dissecting accounting standards and figuring out the real story behind the numbers, you are definitely in the right place. Today, we're diving into a truly fascinating diagnostic case study about changing revenue recognition methods under Ind AS. It sounds pretty straightforward, right? But as you'll see, it's actually anything but. Okay, before we get into the weeds, let's just establish a quick baseline. Please note that the views expressed here are the personal views of the author, and they aren't binding, so always seek the help of an expert before taking any action based on what we discussed today. Also, just to set the stage for our scenario, our functional and presentation currency is the Indian rupee, or INR, and our reporting period runs from the 1st of April to the 31st of March. I also want to mention that today's case study comes directly from an issue featured in the 224th edition of the Gap Advisors Task Weekly newsletter. This is authored by CA Manish C. Iyer, director at Gap Advisors, and it's published right on LinkedIn. To date, over 230 editions of this weekly newsletter have been published, so if you're on LinkedIn, you really need to subscribe to it. It's completely free and just packed with amazing insights. So here is our roadmap for today: the scenario, the group mandate, policy versus estimate, the consistency rule, prior period errors, and finally the retrospective fix. Let's get started. Section 1. The scenario. Company A's revenue dilemma. Here's the deal. We've got Company A, an Indian component of a massive international group, heavily involved in the construction business. Currently, Company A recognizes its construction contract revenue using the output method, but the international parent group has just decided to switch its revenue recognition to the input method. Naturally, Company A wants to follow suit and switch to the input method too, basically just to align with the boss. Section 2. The group mandate. Interrogating the motive. If you're an auditor or sitting in a finance team, you know exactly how tricky these group mandates can be. A parent company almost always wants uniformity across all its subsidiaries. But we really have to ask ourselves, does mere alignment hold up under the rigorous scrutiny of Indian accounting standards? Is because the parent company said so actually a valid accounting reason? To figure that out, we have to diagnose the exact nature of this transition. When a company changes how it measures progress towards completing a performance obligation, are they just updating an estimate based on some new data, or are they fundamentally changing their accounting policy? That distinction is absolutely crucial because it dictates which rules apply. And ultimately, depending on how we classify the switch, how exactly do we account for it to stay compliant with Ind AS? Because you can't just flip a toggle in your ERP system and call it a day. There are very specific disclosure and retrospective requirements we might have to deal with. Section 3. Policy versus estimate defining the change. Let's look at Ind AS 8, paragraph 35. It makes this crystal clear. It states that a change in the measurement basis applied is a change in an accounting policy. It is not a change in an accounting estimate. So swapping the method of measuring progress from output to input for the exact same performance obligation, that's a fundamental policy choice. Think about it. Changes in accounting estimates usually happen because you've got new information, new events, or some kind of new development. But in Company A's scenario, there's no new information at all. They are just making a judgment call to change an accounting policy. And as we know, changing an accounting policy triggers some fairly strict rules. Section 4. The consistency rule. Analyzing Ind AS 115. This is where Ind AS 115 comes in and throws a bit of a wrench into things. Paragraph 40 says an entity has to apply a single method of measuring progress consistently. But pay close attention to the end of that sentence, to similar performance obligations and in similar circumstances. That means you can't just blindly align policies with the parent group unless both the obligations and the actual circumstances match up perfectly. Sure, the parent group and Company A have similar obligations since they're both in construction, but their circumstances completely different. Company A operates in India. The law of the land, the regulatory environment, the local business practices, they're entirely different from the international parent. Because the circumstances aren't identical, a blanket alignment just isn't valid under Ind AS 115. Section 5. Prior period errors. The plot twist. All right, get ready for a massive realization. Ind AS 8. Paragraph 5 defines prior period errors as omissions or misstatements from a failure to use or the misuse of reliable information that was available when the financials were approved. And guess what? This explicitly includes mistakes in applying accounting policies. Here's the kicker. Choosing a method of measuring progress isn't an open policy choice you can just flip back and forth whenever you feel like it. So if Company A decides to switch to the input method now, they are heavily implying that their originally selected output method was inappropriate for their circumstances. We're no longer just updating a policy to make the parent group happy. We are literally fixing a historical mistake in the application of accounting policies. It's a rectification of a prior period error. Section 6. The retrospective fix, correcting the error. So how do we fix it? Well, you can't just make the change prospectively and walk away. Paragraph 42 of Ind AS 8 demands a strict retrospective application. Company A has to correct this material prior period error retrospectively in the first set of financials approved after they discover it. They've got to restate the comparative amounts for the prior periods. And if the error goes back even further, they have to restate the opening balances of assets, liabilities, and equity for the earliest prior period presented, plus all those detailed disclosures required by paragraph 49. It's a huge undertaking. This whole scenario perfectly highlights the kind of deeply technical guidance you'll find on the GAAP Advisors issue repository at gapadvisors.com. That repository hosts over 4,500 issues and responses on Indian accounting standards and Indian GAAP. Anyone can register for free, submit issues, and get detailed responses delivered straight to their email inbox. It is an absolutely crucial tool, especially for auditors who need to rigorously document how they tackled complex Ind AS applications. Well, that wraps it up. Thank you so much for your time today. I really hope this breakdown of revenue recognition methods was helpful. If it was, please hit that like button, drop a comment with your thoughts, and subscribe to the GAAP Advisors Ind AS Clinic channel if you haven't already. And please share this explainer with your contacts, colleagues, audit teams, finance teams, and any students pursuing their CA course. It really helps spread this vital knowledge. Oh, and if you want an even deeper conversational dive into the technical weeds of this specific case, definitely connect to the GAAP Advisors Ind AS Clinic podcast. You can stream it right now on Spotify, Amazon, or right here on YouTube. I'll leave you with this final thought for your next team meeting. When an international parent group demands a seemingly simple policy change just for the sake of uniformity, what hidden historical errors are you really bringing to the surface? Keep asking those tough questions, and I'll catch you in the next explainer.